names like Manappuram because of the RBI action. Speaking of RBI, taking the conversation back to banks, Prakash, stay on. We'll have more questions in just a bit, but just dialing back to banks and some of the earnings that we've seen. Of course, Kotak Mahindra Bank was a disappointment. Primarily, I'm focusing on asset quality because what's come out in the numbers so far is that asset quality seems to be coming under pressure. Samir Bhise, who's banking research analyst at JM Financial, is joining in. Samir, good to have you on. Now, you know, one was always going into this earnings season, watching these points very carefully. By how much will the margin be compressed? And what will be the rise in credit cost? Exactly what is the kind of asset quality pressure that we're dealing with? Now, early trends, if you see the slippage trend for Kotak Mahindra Bank, for, an L&T Finance, or even for RBL Bank, I mean, they make you sit up and really take notice. Your first thoughts on the asset quality trends that we're seeing?
Yeah, hi. Good morning. So we had kind of highlighted in our preview note that 2Q is going to be more of the same of what we saw in 1Q, which is basically inch up in credit costs across the board, primarily emanating from the unsecured space, which is cards, credit cards primarily, personal loans, and to a certain extent also players where there is MFI exposure. That will lead to some bit of challenges in 2Q. Which continues to play out in this quarter. I don't think we have seen the last bit of it. Expect some of it to sustain in upcoming quarters as well. And we have seen this in Axis. We have seen this in Kotak Bank as well. Unsecured stress, the regulator was right to highlight sometime last year in November, which is when they increased risk weights, and I think that plays through most of the sector today. Also, wanted to highlight. Yeah.
Sorry, can you put some number to it? So when we talk about overall asset quality stress, what is the broad band that you're working with for this quarter and for the rest of the year? Whether, I mean, you can quantify that in the kind of rise in slippages or the rise in credit cost or the overall system-wide NPA levels. I mean, some ballpark in terms of what the overall thesis is. And then we'll come down to individual banks and stocks.
Yeah, so if you see, for most larger banks, unsecured portfolio is anywhere between 10 to 15% of the overall book, wherein almost more than half of the current slippages are emanating from. That probably implies that unsecured, especially cards and PL, are running at ratios which are higher than almost 3 to 4% easily. Which is what is probably hurting the credit cost numbers right now. At the same time, microfinance, I think we have seen in some of the NBFC MFI numbers, wherein credit costs are upwards of 3 to 4%, likely to be so even in 2Q. That is how I would put the expectations right now for these segments. But we still think that large private sector banks, despite the challenges, are relatively better placed, given that most of them are carrying excess provisions on balance sheet, as well as it's a diversified book. So it's not as if the unsecured book is a large proportion of the overall loan mix. So I think larger guys should still be relatively better placed.
All right. Hi, Samir. Good morning, and always good to hear your thoughts. Sounding a little bit cautious, I think, for the coming quarters with regard to the stress in the system, though you prefer large private banks in comparison to the rest of the banking pack. Samir, come in on RBL Bank's numbers. There was margin compression there, asset quality as well, clearly not great at all, multi-quarter highs out there. Your view on this banking name and the read-through?
Ajay, we don't cover RBL, so it won't be appropriate for me to comment on that.
Okay, all right. So you like private banks, but what is the top banking name?
Yeah, so we like ICICI and Axis, which are our preferred picks in the private banking space. While Axis had some issues with respect to credit costs, I think they are manageable. There is significant balance sheet cushion as well. And ICICI, obviously, as you have seen, they continue to outperform the industry with respect to growth, ROA, profitability, and asset quality as well. So that continues to be the top play for us. We also like State Bank of India. We think at current valuation, it makes a good case, especially for a bank which is growing at 13-14%, delivering 1% plus ROA. We think the valuations are attractive. So I think these three names I would put at top of my list.
Okay, just to finally wrap things up in terms of worst asset quality, negative surprises. What is the one name that you are watching out for in your coverage, and also margin compression? I mean, between the best and the worst, just leave us with the names because we'll wait by and see how the actual numbers look. But the expectations.
So I think, at least from the larger private sector lenders, I don't think one should worry much. But we would watch out for banks which have higher exposure to the unsecured segment. And that could probably be some of the smaller and second-run names. We also watch out for the microfinance asset quality, as has been reflected in some of the banks that have reported right now. At the same time, what one needs to look out is how the rate cycle plays out. While we are probably looking at a rate cut, most banks are now on the large side of the asset base is now floating in nature as well as linked to repo. So we will have some bit of margin compression when the rate cycle cut commences from the RBI. So overall, we remain slightly watchful on the sector as a whole.
All right, Samir, we'll leave it there. Thank you very much. Good thoughts and good to get them early morning. Anuj is now standing by.